In today's video, I am going to be breaking down EIT. It's basically a high dividend fund, and it's actually quite interesting. So this one is, full name is Canoe EIT Income Fund, and its ticker is EIT. So let's get down and let's really check out what this fund is really all about, because its dividend is extremely high. So as we can see here, the fund itself invests in the public equity and fixed income markets of Canada and the United States. Its equity portion seeks to invest in the stocks of companies operating across diversified sectors. The fund primarily invests in growth and value stocks of mid-cap and large-cap companies. It invests in equity and debt securities of royalty and income trusts, corporations, partnerships, or other issuers. The fund was formerly known as Enervest and blah, 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 blah. We can keep on going and actually check out the actual fund itself. So currently, at the time of recording this video, it was valued at $12.22 per share. Its dividend is absolutely massive at 9.82%, which is absolutely fantastic. This would be a massive reason to invest in this fund, especially how it has extremely high volumes, so you can get in and out whenever you would like. And its price to earnings ratio is 24.5. Now, of course, you would only really want to compare that number to other income funds. Now, when you start looking at the 5-year chart, you'll see that it pretty much traded sideways from about 2017 to about the end of 2018. Then from 2019-ish to about the coronavirus pandemic, it traded sideways but below where it was trading back in 2017 and 18. And then we have the coronavirus pandemic, and since then it has exploded upwards back to where it was before all of this downwards momentum. So it's back to where it was back in 2017. Now, the reason why I personally would not invest in this fund is because of the continued downward momentum that we see in this fund. This would have been okay to pick up during the pandemic and to sell right about now. You could have had a nice massive return while holding dividends during that time. And you could even play this fund whenever you see this happen again. So for example, what we see is a massive downturn in 2008, and it was paying substantial dividends back then, and you could run for the growth through the recovery. However, once the recovery was over, it starts falling again. Right now, I think that we have finished the recovery. I don't think that there's any more positives that could happen when it comes to the stock or even our economy. I think we are pretty much at the max. From here on out, I feel like there's going to be a downturn, and not necessarily a downturn in broad market. We're going to see tech. We're going to see a lot of the high dividend growth or a lot of high dividend stocks like the banks really outperforming between them and tech. However, this fund, we can see that once the growth is finished, it turns down. Once the growth finishes, it turns down. And then when there's nothing really happening, it tends to trade sideways. And let's face it, there was really nothing happening from 2016 to about 2020 before the virus. It pretty much traded sideways. So, if you're looking at, of course, EIT, personally, by just looking at the chart, I would be personally staying away from it until there's another downturn. Maybe another virus comes out, or maybe there's a housing crisis in Canada, because, of course, housing prices here in Hamilton have gone up 25% year over year, which is absolutely ridiculous. Another reason why I would personally not be investing in this fund is the dividend. So, of course, they do pay a dividend every month, which is really nice. When you start moving down this list, yeah, okay, they're paying the same dividend. There's no increases to the dividend. However, when you start going down further, 15 cents. They lowered it during the 2009 crisis to 10 cents. They've never risen it or rose the dividend since 2009. When you start going a little bit further down, 21 cents. Whew. They went from 21 cents down to 10 cents. Oh wow, look at this, 63 cents down to 10 cents. Personally, when I start seeing stuff like this is not something I would personally invest in. This is something that I could trade, maybe over a short period of time, maybe a 6-month or a 1-year period of time. Whenever there's a downturn, get a super high dividend, and then basically run it, like just basically ride with it while it runs up, and then get rid of it and invest in something else. I know there's a lot of people who say, well, I just want to invest into it for the dividend, and that's fine, but you have to remember that your cost of living is going to be going up every single year, about 1.5 to 2.5%. And because of that, you would want to have an increase in your dividend much higher than 2.5%, which is why I like banks, personally. And because of that, when you start looking at that and saying, okay, there hasn't been any dividend growth since 2009. We've been trading sideways for the past 3 years, 4 years. It's not moving upwards. It's not increasing its dividends. Sure, it's giving you a 10%, close to 10% dividend, but why would I want to invest in that when I could invest in something like a ZWK that's still a new ETF but still high dividend, close to 7% right now, and gets probably around a 4 or 5% return on investment plus a 6.5 to 7% dividend right now? Or why not invest in something like a TXF, I think that's the ticker, where if you're getting maybe a 5 to 10% return plus a 10 to 11.5% dividend, that starts looking a lot more attractive than something like this. However, this has its benefits. If we have another downturn, this could be a nice fund to invest in. Wait till it gets close to the bottom, invest into it, let it ride up for 6 months, get a 10%, 9%, whatever dividend while it's riding back up, sell it, and then make your whatever it would be, 10, 15, 20% plus the dividend, and then invest that all into something else that we all see market rotations every 3, 6, or 12 months. Follow the market. There's some solid ETFs that you can get. This doesn't give me a list of what they invest in, or just the ideals of what they invest in. So what you can do is find some good ETFs, ride with them long term, and then have 10, 20, 30% of your portfolio, like I do, in riskier stocks or more like weekly, monthly, day trade type stuff. And then you can have a much higher return. That way, for myself, I can get that 12 to 15% return every year, which is higher than the market, while still grabbing an average. I think right now I'm averaging around a 6% dividend because of that. So this gives me close to a 20% return a year if you include the return on investment plus the dividend. I hope that this video has helped you. If it has, hit that like button, subscribe, and I'll see you guys in my next video. Make sure to always do your own research and never trust a random person on YouTube.